Well, good afternoon, everybody, and welcome to our March 9th pre-St. Patrick's Day session for the Bull Sessions. My name is Mark Robertson. I am founder and managing partner of Manifest Investing. I'm joined here by my dear colleague, Ken Kavula from mid-Michigan. Good afternoon, Ken.
Good afternoon, Mark. Good afternoon, everybody. Glad to be back. Sorry I missed last week, but this couldn't be avoided.
You were missed, but we're glad to have you back. We're also joined here by special guest Kim Butcher from Florida. Good afternoon, Kim. I think Kim is still with us. She's probably
has her mute button on, maybe.
Muted away. I know she's juggling.
No, she has dropped off, Mark, so she's not with us right now.
Okay, she probably had a family thing to tend to. She may be returning. Okay. All right. Well, let's go ahead and get underway. We're going to cover buybacks and discuss them in general and how we might think of them as educated investors. I do want to give a quick update, courtesy of George Mackey, on how much carnage there has been in Groundhog Nation, and I'm really glad it's early, Ken, because the carnage was handed out pretty handily here over the last 10 to 14 days.
And well, I'm a pretty happy camper. I got a lot of names in the top 40, Mark. So
I know you're swimming against the tide.
Yeah.
And I do want to, with your permission, at least launch the discussion on this notion of defining core as we do it at Manifest Investing. And we will see there. Kim says she's been muted by an organizer. So maybe you can take care of that, Ken.
I'm not seeing Kim on the... Okay, I'll take care of that while you keep going, Mark. All right.
Okay. So let's go ahead and get underway, and we are going to celebrate Kathy Wood here for a little bit too. No investment recommendation is intended. This is all about education. Everything that we do here is to illustrate and demonstrate a philosophy, a method, a technique, a form of analysis for identifying excellent companies and when they are attractive purchase candidates, and literally how to build a portfolio and maintain it to experience successful investing. Everything that we do has been shaped by 8 decades of experience and lessons learned by the Modern Investment Club movement, as inspired by the National Association of Investors, Better Investing, and as interpreted by Manifest Investing. Everything that we kick around here today are our own opinions and views. Please know that. And please, please, please do your own homework before taking any investment-related action based on the stuff that you hear today. We do try to remember to disclose when we own things in our portfolios or know people who do. We do a monthly webcast known as the Roundtable. We've been doing it for 11 years. It's always on the last Tuesday of each month. And if you'd like to be added to a reminder list for that webcast, it's 8:30 Eastern Time, last Tuesday of every month. Please send an email to nkavula1@comcast.net. And if you have follow-up questions, suggestions for future topics, or if you'd like a copy of the slides, send me an email at markr@manifestinvesting.com. Let's go ahead and roll into our bullpen and our queue of things that we would like to talk about. This is always changing. We do get suggestions from all of you. And today I thought we would focus in on some of Buffett's words about buybacks from his annual letter to his shareholders at Berkshire Hathaway. George Mackey is going to provide a look at the Groundhog carnage, along with the consensus selections for this year. And I thought Ken and I might start brainstorming a little bit. We've had brief conversations about this. I'm not even sure how he will react, but we'll go ahead and talk about this notion of people are always trying to get us to define core versus non-core and how we define it. And I think maybe using the stuff that Nicholson has given us over the years, we may be closer to a way to think more like an engineer, less like an artist when it comes down to defining that sort of thing. Your thoughts, Ken?
I would like to walk a very fine line to the right side of the engineer, okay, if we could. I don't want to get us into 5 and 6 decimal calculations in any way, shape, or form. So let's see where we're going with it, Mark. Okay.
Hey, if you can get out to 6 decimal points, man, you've got it nailed. How many digits are significant? That sort of thing. You see the other topics. We'll be coming back to some of these. Kim just advised me about a book on Bitcoin that we might want to take a look at. Kim, are you back with us now?
I am, yes.
What was the book that your book club looked into that did a good job of explaining Bitcoin?
Let me go get my iPad to tell you what it is.
Okay.
It gave me a lot of clarity to understand what the heck it's all about.
She's in a very high functioning. Go ahead.
It's called Layered Money.
Is that it? Layered as an LAYERED?
Yes.
Okay, Layered Money. I'll add that to the notes.
Is there an author, Kim?
Pardon me, Ken?
Is there an author?
It is NIK space BHATI. BHATIA.
Okay. So we'll take
From gold to dollars to Bitcoin to central bank and digital currencies. The layers of money.
So perhaps we can take a closer look at that. I saw Morningstar had a feature on basically surrendering to the reality of cryptocurrencies this morning. So that's kind of cute. All right. Let's go ahead and get underway with just a quick look at the carnage that is the current Groundhog. We were celebrating no less than a week or maybe 2 weeks ago an average total return of about 7% already, 3 weeks into this year's marathon. And that's all changed pretty dramatically overnight. Only 48 of the 144 entrants in the contest, 1 out of 3, are beating the market anymore. And in fact, there was a day, in fact, George and I were talking on that day. What was it, George, last Wednesday? Is George still unmuted, Ken?
No, he's back muted again, but I can unmute him pretty quickly.
And George Mackey and I were talking about how rough the stock market in general was being on companies, and I'll be darned if it didn't almost. The Wilshire 5000 almost made the top 40 list, so you know how gruesome that had to be. And
George is unmuted, Mark.
Okay, thanks. And so we just kind of kept kicking things around. I've been tempted to cut this list shorter than 40, but once again I had a reason at number 40 to leave it at 40 this week. So
well, thank you.
and Ken, would you like to assume ownership of a good piece of this list?
Well, I belong to the Mid-Michigan Model Club up in number 7 and the B.I. Baker Model Club in number 14. And those entries, both clubs basically are entering stocks in this contest. And I put my hand in the air and swear that every single stock in both of these portfolios, these clubs own. What we did was we took and made a dashboard of the Mid-Michigan Model Club, and then I think picked the top 10 from that dashboard. Might have been the top 6 or 7, I don't remember for certain, Mark. And the same thing with the B.I. Baker Club, made a dashboard and then picked the top stocks off of there to enter it in the contest. Here's my notes. We picked the top 5 from B.I. Baker and the top 6 from the Mid-Michigan Club and enter them in the contest. So they actually own these. They're doing quite well, and that's the kind of thing that contributes to stock clubs that continually beat the averages over significant periods of time. Both of these clubs are doing that at the moment.
Cool. Well, I'll make one other observation before we move on. We do have a potential cage match forming again. It could be Wichita versus Mid-Michigan, because these are all connected or affiliated with John Kimmel. Some former champions there. So we could have Wichita versus Mid-Michigan in the cage match at some point in the future. All right. George has joined us today. George is from Houston, George Mackey, and he's holding down third place. His results have been a little mixed over the years, and he told me he's happy to be up at the top of the leaderboard this year. So congratulations so far, George. We do know it's a marathon, not a sprint. But here's some information that George had put together. I'll let him walk us through it.
I took the list that Mark had put on the forum and entered everything into an Excel spreadsheet. I had 129 people picking over 1,100 stocks. When I did a pivot table on that, there were 442 unique stocks. 251 of them were only picked once. So there's a lot of uniqueness. When I went up to where's the natural cutoff, 20 seemed to be the natural cutoff. The 21st position, there was like 8 or so stocks that had the same number of picks. A2 Milk had 2 tickers. I just combined them. Alphabet has 2 tickers also, and I debated on whether to combine them as one or both, but one of the tickers was picked 17 times and the other ticker was picked 17 times, and there's one person that picked both tickers.
Yeah,
so I decided to leave them as separate companies.
Yeah, that one person actually doubled down on Google using the 2 different tickers. Interesting strategy. Could work out very.
And the numbers do look slightly better today. The 20 is up 2.7% today. It's still trailing the Wilshire 5000.
Yeah, and this I think this snapshot was taken right around the time of the market trough, wasn't it, George?
It was the middle of the week last week.
Yeah, so there's quite a ways to go, and this is one of those moments when many of us just are thankful that there's 11 months left in the contest. Good stuff. All right, one of the things I did want to point out, using your top 20 list, George, I put it on a dashboard that's also amongst the dashboards listed in the forum, but just wanted to point to why some of the disruption. And you can see that it's half technology, and then discretionary at 21% means that basically 3/4 of the fund is very economically sensitive. So we shouldn't be surprised by some pretty volatile results here lately. All right, and George, I thought we'd give you the chance, since you're in third place right now, just to kind of give us some insight into what was your mode of selecting your 10 stocks for this year.
That's actually what I own. This is my portfolio. I own about 7 other stocks, but these were the top 10, and I like to do around 10 in the past. My 5th through 10th stock positions have already outperformed 1 through 4. So I kind of hate to cut it off at 5, just went to 10.
Well, you guys are gonna get me emotionally involved with everybody owning the stocks that are in things like the Groundhog. It becomes less hypothetical, I guess. Wow. Good stuff, though. Congratulations on the solid start. Any comments or questions, Ken?
No, but I wish I would have discovered ADS a lot sooner than I discovered it, George. That's all. So,
yeah,
and kudos to your holding of Western Alliance. That's a bank that 2 of my clubs have held for quite a while, and you had to be very patient with this bank, as you did with most banks, but boy, has it paid great returns in the last 6, 8, 9 months.
Well, I was the only one to pick ADS. There were 6 people that picked Western Alliance.
Absolutely. All right, let's go ahead and pick on Kathy for a minute, and again, keep in mind that I have the deepest respect for Kathy. And when I say picking on her, people have actually featured in our forum some obvious references to the fact that she thinks like we do, right down to the 15% number, Ken. And I regard Kathy Wood and ARC as a source of great ideas. Absolutely.
I was very surprised to hear her yesterday. She did a live interview yesterday on CNBC. Where she also articulated a 5-year time horizon for her investments, Mark.
Exactly. Yep.
I mean, it's right along the same lines that we've been working on, and for her to get all this recognition for doing the same kind of investing that we know works is heartening, very heartening.
It is. But she does spend a lot more time on the aggressive / assertive side of investing. And we know that's going to be by definition more volatile. So articles like this are coming out right now because they are way down. Of course, we're poking fun at them by saying they're 142nd out of 144 groundhogs. But I also had another hot dog moment today. I actually wanted to invest in ARK-K this morning, and I forgot, and I got to putting together some of these slides and remembered it around noon, right around lunchtime, hot dog time. And by the time I had checked, ARK-K is up 10 or 11% already today. So that's how this stuff is moving around. I want you to notice that this morning, when I prepared this particular slide, the relative strength index was at 25.6. But the thing I want to point out is even though it's getting all this abuse for being in really a cold snap when it comes to the fund performance, it's at the top of the list for longer term performance. Now, they've only been around since 2014 as far as that particular exchange traded fund, but that has blown the doors off of the market since December 2014. And you can see some of the characteristics right there. Notice the growth column here, Ken. That kind of jumps off the page at me every time I put this particular slide up, that growth matters. Having enough small companies and faster growing companies really does matter. And that's how you get to the top of this list. And there's several hundred funds on this list. This is the top 20. So she may be cold right now, but again, I was willing to bet on the bounce this morning and I just forgot to do it.
Mark, do we get a little bit more information anywhere else on the Manifest site about the actual size of the portfolio for any of these?
Well, we're currently reworking the fund area, and what you will have is the same thing we have always had, with the listing of the holdings and in more information about the fundamentals, core characteristics of the funds.
Yeah, she got the question yesterday, or a variation of the question of when do you become too big to make a difference in, and to have your returns be so spectacular. And she ducked the question. So I just wondered about how big is this particular fund compared to some of the other funds dollar-wise,
Yeah, she's gotten that question a few times. In fact, Jim Cramer went so far as to recommending that she close the fund to new investors, which I'm not even sure you can do with an ETF, but he did make that recommendation. Yeah, well, you got to remember she's also investing, a lot of times with a small company fund like Brown Capital, small company fund, they are investing in small companies. So they do reach a point where it becomes very difficult for them to take on a whole bunch of new money and find a suitable home for it. But she's investing in Tesla and a bunch of larger companies in addition to some of the smaller ones. So she's probably got a little more to run until she runs into that same type of constraint, would be my guess, my take on it.
Yeah, I'm getting from a number of different people various dollar amounts for the size of ARK's net assets. The most recent one that came across the question box here is $23.5 billion, and that's coming from Cynthia Petrika.
Oh, yeah. That's pretty reliable then.
An unaudited number, Mark. Okay. So.
Right, and somebody wrote about it last week. I think it may have even been in Barron's, that the inflow of new cash to the ARK funds is actually topped the most rapid inflows at Vanguard over the years. So that gives you some idea of how they're definitely getting a lot of coverage. I would like.
Sometimes when you get that kind of coverage and that fast of growth, it's going to be really hard for them to be able to deploy things.
It will be an interesting thing to watch. There's no doubt. I mean, as they age and can they stay at the top of this fund? this list, I think they probably can, but it will be a fascinating study to watch as it unfolds. All right. All right, Ken, I thought I'd do a shameless plug for Successful Investing 3.
Well, thank you, Mark. That's my dog, by the way, barking at a cat which has dared to come up on our deck. So I can't get out of my chair to go quieter, and my wife is not here right now. So you'll need to put up with it for just a little bit.
Yeah.
I have yet to get the panel fully assembled for Successful Investing 3, but I'm hoping to at least have our star back, that's Pat Donnelly, and ask him to come back and sit on the panel again. I noticed you've put an arrow by that Stone Company and that 178.5% return, and that's from the second conference that we did, and that one was dated sometime in
It's May.
in May, right, May.
All right.
So interesting, very interesting.
All right, so mark your calendars, and we'll be out with a little more information on that here pretty soon. Do you want to go take care of Roxy, and I'll press on?
I will do that.
Okay. We'll let Ken take care of Roxy. I'll go back to that slide and just point out that again, we have a lot of the people, if not all of these participants, returning for the session in mid-May, and I would take any of those returns from a year ago, those May 2020 returns, and the selections that were made in November, just before Thanksgiving, have actually done pretty well collectively also. It's an amazing market that we live in when we see 15% return over 4 months, and all we can do is yawn about them because companies like GameStop are going up that much between 10 o'clock and 11 o'clock in the morning. So wild stuff. All right, let me go ahead and press on. Ken, are you back with us now?
I am back with you, and doesn't take much to quiet her down. He's got to grab her. That's all.
I figured you resorted to the green beans or something. All right, let's talk about buybacks, and this is an area of some debate / dispute amongst investors and people on the street, and there's a fair amount of confusion in the investing world. I think some of the discussions parallel the same type of discussions about passive versus active investing, and or value versus growth, and all that kind of stuff. But I really do think we can go ahead and take some of Buffett's comments from his annual shareholder letter to his shareholders at Berkshire Hathaway, and some of the stuff that he had to say about buybacks, maybe take some of the haze away from it. It's probably not as complicated as is made to be, and I really push back personally on this notion of making them illegal. And Kim and I were talking before we got started about how the banks were forbidden from buying back stocks, probably during a period when it made the most sense. And now they're allowed to buy back, and their stock prices are all several percentage points higher. It's just not. Sometimes when the government is there to help, they don't help, and that's all I'll say about that.
I think, Mark, when we listen carefully to the testimony of our Federal Reserve people or some of our other experts, Treasury secretaries, for example, we listen to their testimony before Congress, and we become acutely aware of the lack of economics training, even basic economics training among many of our elected officials. They're looking for a headline all the time, but the headline doesn't necessarily hit any nail on any head.
Yeah, and they leave out the nuances an awful lot. All right, here are Warren's words from that letter to the shareholders, and just pointing out that they bought back some shares of Berkshire Hathaway over the course of the last calendar year, and you see that number reflected down here in this data array. This happens to be from Y charts. The reason I point that out is if you go looking for that difference in value line, they haven't caught up with it yet. They don't show a decline in the number of shares for 2020 over 2019. I think they will, on the next update. But that's a consequential amount of share repurchases. He says right there up at the top, let's call it 25 billion. Of course, in this day of trillions, 25 billion isn't so much money, but seems like a lot of money to me. And basically what it comes down to is they think it's the best decision that can be made with the funds at Berkshire Hathaway. And we'll talk about what that actually means. But the one thing, and I think this dovetails right in with what Ken was saying, we have witnessed time and time again where buybacks take place and they don't seem to make a whole lot of fundamental sense. And that's what Buffett's getting at there in that third paragraph. We can find companies where the prices have risen up and suddenly the company is in repurchasing shares. We'll talk about what that transaction actually looks like here in a second, but they're basically buying back shares that they probably shouldn't be. And it's for propping up things, and it's the worst kind of engineering. And Ken, I don't know if you want to walk to the right of that engineering comment, but financial engineering.
I do like what Matt Spielman's been writing about the share issuance concepts that are coming out of some of the companies that had to issue large numbers of shares to keep themselves afloat during the pandemic. The cruise lines come to mind, and he's been writing a little bit on the forum about the cruise lines. But I think it just behooves all of us to, when we maybe don't always take into account the change in the number of shares, I think in this time of a lot of buybacks and a lot of issuance of new shares, we need to maybe make that a little bit more important in our analysis, especially if we're looking at a company that experienced significant disruption in last March, April, May, June, that time period when the pandemic first hit.
Mm-hmm.
Well, and I also think that one of the things we should do as investors is we should be checking the financials to see, have they bought back shares, and then are they retiring the shares or not?
Good point, Kim. Real good point. Yeah. Or are they just going to other people? Yeah, they're just being shuffled off to other people. Yeah.
Yep, and they can be taken into the treasury shares, or they can actually go into the unable to issue pile also, and that you can discover that by digging a little bit deeper into the fundamentals. Now, Kim, I want to know if there's any truth to the rumor that the picture actually represents a typical lunch when you're buying stocks: cherry Coke and peanut brittle.
Not for me personally. I'm not a Coke fan. I gotta go for Pepsi instead.
Heresy,
I know.
sheer heresy.
Just because, I may have the Berkshire stock, but doesn't mean I have to drink the cherry Coke.
Mark, we're getting a little bit of a question about that. That seems, if you could go back one slide, that seems like really quite not very many shares, but that's the Class A shares that are selling at hundreds of thousands of dollars each. So
Yeah.
that 81,000 shares, that's really quite a bit of money. You have to equate that with the 24.7 billion. And in a normal company, that would, you might figure they were going to buy back 800,000 or even 1 million shares. But this A shares has a huge value attached to it, dollar value attached to it.
Right, and you have to remember, for every one of those A shares, there would have been 1,500 B shares.
Right.
Repurchased. So yeah, it adds up to the number. I checked, just to be sure. All right, and for those of you that may be unfamiliar with some of the terminologies, just a quick reminder that Investopedia is a great place to turn to. Repurchase and a buyback are the same things. What it really amounts to is removing outstanding shares. And as Kim mentioned earlier, it can be as simple as putting it in, retaining ownership and keeping them active, but in the ownership of the company. And that's a key thing to understand. And it does affect the number of shares outstanding. So obviously, any calculation that is a divided by share calculation is influenced by the number of shares out there. So that left-handed remark I made about engineering, there are some companies that actually do prop up their earnings per share by driving down the number of shares. And some of them have been done, at least historically, in situations that probably don't make a lot of sense other than maybe trying to hit some type of an incentive target or something. Tough stuff. All right, so one of the things I wanted to take a quick look at, this is a look at one of our chronicles from Manifest Investing on Berkshire Hathaway, and I wanted to look back and see if this would represent that last year or so, the right-hand side of this chart. And sure enough, there was a moment in here where I believe Warren and Charlie probably did sit down and say, I can't find anything else better to do with the money. And we happen to have $125 or $130 billion sitting around. So again, if your company is buying back its own shares when the return forecast or the projected annual return or the projected return on value is at a high point, that's a good thing. If your company is doing the opposite of that, as suggested by Warren in that paragraph, then maybe you want to scratch your head about, what are they really trying to accomplish? What is being accomplished? One of the other things I wanted to do with this slide is go back and look at the inputs to the projected return on value calculation and just go back and just take a rough look. This is a really cursory, rough look at year-end conditions all the way back to 2011 just to see how that compares. And the conclusion I reached there is there probably was a slightly better time. Back in here, we'll take a look at the next slide here in a second. That would have been a better time to buy Berkshire Hathaway shares back towards the end of 2015, and that's what we see here. So here and here were the two times where the return forecasts became elevated to the point where the buybacks probably were more logical. I happen to think that the one on the right, the 2020 buying opportunity, was more a case of they couldn't find anything else to invest in, either as an equity or assuming ownership of a company. So I ran the numbers real quickly using the industrial version of projected return on value and wanted to compare them side by side to the asset-based business version of projected return on value. Remember that the projected return on value is the projected pre-tax income divided by the market cap plus the total liabilities minus the cash equivalents for an industrial company. For a financial or an asset-based company, it's simply the projected pre-tax income divided by the market cap, which is basically the stock price, plus the book value. And you can see that the two track pretty well together. A little bit less on the asset-based version of the calculation, but close enough for, Ken, I don't think you're going to accuse me of 6 decimal places here.
No, not at all, Mark.
Okay. I consider these two numbers to be the same thing in my world.
Well, I always have, yeah. So I agree with you, absolutely.
And we believe
you might have picked one of the easiest ones to argue with, but if you look at to either side of the pairs on either side, that definitely makes the point.
Yeah.
666 and 65 and 68, yeah.
Mm-hmm. So we've been using fat crayons for a long time, long before Reddit came up with the apes and the chimps eating crayons. So that's if you dip your toe in the Reddit waters, it's just an amazing thing. All right, here's a closer look at Berkshire Hathaway over the years, just looking at our business model analysis. Current day conditions, we see very similar projected return on value numbers lining up pretty closely with the projected annual return. It's a behemoth conglomerate, amazing company, and the book value is certainly very well behaved over the years. And this one glitch really does come down to the change in accounting rules and just some turbulence in the technical side of things back in 2017, and kind of an accounting glitch. So good stuff. All right, so I guess I would just close the argument on buybacks by simply saying that if your company is buying their own shares when it makes sense on a stock selection guide, I'm all in. I'm okay with that. And if they're buying back their own shares, and you can't see the value with a stock selection guide or a business model based stock study, then I think you start asking questions and wondering about what's going on. Fair enough, Ken?
I think fair enough. And Mark, I'd even be able, for a company buying back its own share, I'd even wouldn't fault the company if it stretched some of the rules a little bit and maybe went down as far as a 2.5 to 1 upside downside, or even a 2 to 1 upside downside. But a lot of times when I'm looking at buybacks and when I'm doing a matchbook, back of the matchbook calculation, I'm coming up with upside downsides of 1 to 1 or even less than 1 to 1, and that's just frivolous as far as I'm concerned. Then,
so it's something to watch and keep track of. Kim, any closing thoughts on the subject of buybacks?
No, I just know that Buffett, 2 years ago, it used to be judge for Berkshire shares by book value, and he's changed it to cash flow.
Yeah, we talked about that last week. I think that reflects the shift in the overall business model from basically a big, as my grandson would say, ginormous insurance company, with a bunch of other, Dairy Queens and underwear companies hanging off the side of it, to a true a company which is probably more than 50% industrial now. It's not just an asset-based company anymore, so that's where it begins to fall apart. Plus, switching to the market price calculation made him look better this year and last year. Flippant comment. All right. Well, Ken, here's one for you. We started talking about this. I thought we would continue the theme a little bit because this one's kind of got me. The notion here is the depression in commercial real estate and the abandoned malls and the heinous condition of some of the commercial real estate situation nationwide. And we talked briefly about this last week about a few companies that are actually converting some of the abandoned mall space into residential property, condos or annexed apartment complexes, that sort of thing. I find the concept fascinating as a potential path. I mentioned it to you. The picture, the reference last week was to the mall closer to Philadelphia. This particular mall, as I understand it, is in the Syracuse, New York area, and they've actually begun dabbling in this concept. And before I turn it over, I'll leave with one thought on this that really intrigues me. Is we were driving back from tennis last night and driving by Great Lakes Mall, which happens to be on the north side of the Detroit area, and I tried the concept out with my spouse, and I fully expected to be ridiculed and skeptically abused, and she says that sounds kind of intriguing. So that's the acid test, Ken and Kim. I mean, she's like, yeah, that would be. I would consider that. Your thoughts?
Well, I know. Back in Evansville, Indiana, there's a mall there that had Sears as an anchor and had another one at the other end. That both of them are gone, and one of the local hospitals has bought, I don't know, 25% of the space in there, and what they use it for is physical therapy because it's a central location. And the other thing they do is they have a whole lot of the when people have to come in for knee replacements and hip replacements and they're pre-testing and all their therapy, that's the location for it. And you've got all your parking that you need there, and they've got doctor's offices in there. So yeah, it's been happening.
All right, and now Ken, I want to hear you tiptoe very carefully around this one because Ken knows my wife very well.
Well, Mark, the nearest mall to me is in Flint, Michigan, and most of you in the audience know that Flint is a poster child for economic problems, and it has been for maybe 20, 25, 30 years. And the mall has seen almost all of its anchor stores go through different reiterations and then closings. They had 4 at one point. They've lost Sears off of one corner, and they had a number of different stores that ended up with a Burlington that then closed. We're still carrying a Macy's and a Penny's, but Penny's doesn't seem to carry any business anymore. So, but what has happened in that mall is that it's attracted the University of Phoenix, and it's attracted our county district library. Our library is now taking up about 12, 13% of the mall.
Wow.
5 stores that used to be stores have made it into a branch library, and it's turned out to be the most popular branch library in the entire system. On top of that, University of Phoenix has opened up with a large number of classrooms. They've taken up maybe a quarter of the space, and there's still retail in the mall, but it certainly provides a different kind of a mix and a different kind of person coming to the mall. Maybe this mixed usage, which very well could include housing, maybe that's where we're going to head in some of these malls in areas that economically just can't support 100 stores all in one place anymore. So
yeah, there were a couple examples cited. We shared one of the Chain Store Age trade journal publications last week, and here's another one speaking specifically about residential real estate coming into a mall near Philadelphia, and then this other one was in New Jersey. And especially if anybody out there and knows anybody in these areas or has any experience with this, I'd be kind of fascinated to hear about it, because it is kind of a fascinating concept to me. And yeah, Ken, the reason that this kind of came up is we were revisiting the Jim Cramer reopening stocks, and we had talked briefly about this Simon Property Group. They certainly fit that mold of companies that probably were more than probably, they were damaged badly by the pandemic. And I just got to wonder if some of the Simon properties actually falls into this class. And just to demonstrate how we might go shopping, this is actually an instant industry study, or just a quick industry study at Manifest Investing, looking directly at the real estate REITs. And I think it could make for an interesting study, especially to see where somebody might be very strategically and thoughtfully, pursuing this type of thing, because I think it's got some legs. And you've got some very interesting names on here from Macerich. I'm pretty sure that Simon is the second largest in the country as far as malls, but you've also got Kimco, and I think Tanger's on here also. All of those have to be pretty impacted by the pandemic, and possibly kind of a re-engineering, redeployment, repurposing story as far as the potential goes.
It's interesting also, Mark K. Light makes the point that the mall in Hastings, Nebraska, that's a 26,000 population, is actually being demolished, and it's going to be replaced with a 55-plus community that plays into one of the other big things we've talked about, which is the need for housing at the millennial side and at the baby boomer side. Different kinds of housing, obviously, but these large plots of land with plenty of space in desirable areas might very well end up just being very nice, fully contained communities without the mall building itself even.
Absolutely. Hastings, Nebraska. Story for another day, but that's where I bought my first Apple computer. In the mall in Hastings, Nebraska.
Oh my goodness.
So I know it well. Interesting. Very cool. Quick look at Simon to show the size of the disruption from the pandemic. Here's your price disruption right here. Obviously quite notable. Here's your top line sales disruption. And the question will be, what does this look like out here? And that's the subject of a well-placed study and a search for opportunity.
Yeah, just a quick reminder to everybody out there that the dividends that are thrown off by these REITs are classified not as dividends by the IRS, and you do have to do a little bit of different accounting for your taxes if you own a REIT, but it's not that complicated. It does make jobs for a club treasurer a little bit more difficult, and REITs are probably not the best investment for an investment club. But for individuals, REITs are, as long as you understand that you're not really getting a dividend and that the tax rate will be a little bit different, you'll be all set then.
Good point. Thanks, Ken.
Mark, why isn't American Tower on this list, or is it just you just didn't grab it?
They wouldn't qualify as a retail REIT. They're in the REIT list for sure.
Okay, so this is
down.
trying to focus on retail. Okay.
This is subdivided down into call it a sub industry.
Okay.
All right. With that, we've got a few moments we can spend on this. This is a topic that we have wrestled with over the years, and especially with our recent conversion of the roundtable tracking portfolio into a core component and a non-core component. And I would even point to the experience of investment clubs that do bifurcate their portfolios into their up, straight, and parallel contingent and their whatever you want to call, non-core, less traditional, speculative, however you want to, what kind of tag you want to put on it. But again, 75 to 80% in your up, straight, and parallel core part, and then the other stuff, have some fun. And it can be a good thing, but we constantly are asked to classify core, and we kind of push back with core versus non-core is really in the eye of the beholder, and that's still true. But I'm wondering, this is something Ken and I have kicked around a little bit, but not a lot, so you're kind of hearing us, you're witnessing us wrestling around a bit with this one.
Well, the N stands for number of years of being publicly traded, right, Mark?
Right, or years of which we have meaningful information to build an understanding with the company. So, I think that N is a function of when was the last recession. You could make it 10, but I'm just throwing out this notion of, do we possibly have a solution staring us in the face? And I came up with the 210 just basically thinking about how we do like to center on financial strength of B++ and above, which in a parochial scoring system might be a 70% number for financial strength. And when it comes to up, straight, and parallel, we'll tolerate a little bit of wiggle, but not a lot of waggle. And, something in that 60, 70, 80 range for earnings per share stability makes a lot of sense to us. And then when it comes to quality, 80 represents the break point for excellent versus good. But, we would shop amongst companies between 60 to 80, leaning towards that 80 side most likely. But when you basically establish a percentile ranking for all three of those characteristics of 70 and basically begin looking for all three of them, I'm just wondering if those three numbers, when they add up to 210, don't start to make some sense.
So these are three percentile scores then, right from the dashboard, correct?
That's correct.
Okay.
So what I thought we would do is jump out and take a quick look at, well, even like the heavy hogs, the ones from that George put together. Can you see that okay on your screen, Ken?
Yep. Mm-hmm.
So, in terms of companies that you would deem core on this list versus non-core. Well, Ardelyx is a slam dunk non-core, right? A company like
I'm just reading. I'm reading down the list, and I agree with you that Ardelyx is
LGI
definitely
Homes.
not. Well,
LGI Homes.
A2 Milk is definitely non-core in my book as well, Mark.
Right, and it's coming in under that 210, and plus they have a limited operating history, so that one's pretty simple to classify as non-core. I look at LGI Homes, which many of us look at as pretty formidable, and I'm seeing, again, that this is kind of a borderline condition. They do have a little bit less operating history to lean on. So that would be one that would be really kind of on the fence to me as to whether
So
or not.
the operating system would still keep Alibaba off of the core list then, right? Because I don't believe it is a core stock, but it would keep it off the core list, even though the number is 220, 226.
Yeah, even because they have such a limited operating history.
Because it's a short history, maybe 3 or 4 years. Yeah.
And
I definitely think it has potential, Mark. And the only thing that I think I reacted to the last time we spoke was that maybe we blur the line at 220, and we make it user's choice from between 200 to maybe up to 230 or something. I've found that that's what we tend to do with the rules that we create anyway.
sure.
That when they're close, we say, well, here's an exception, and then we don't worry about it too much. I still don't think that we can give everybody a hard and fast rule for every single company, but I think this is well on its way to doing it for a good 95% of the companies that exist.
Yeah, and I think if we hit on a characteristic which resonates 90% of the time, and it has some consistency to it, that's got some validity. And I think a company like LGI Homes being on the fence, again, that in the eye of the beholder, that's okay with me.
Yep, absolutely.
And in fact, it probably becomes a function of how comfortable the person who knows the most about them, the person studying or owning LGI Homes, how much information they feel they have and their confidence level in that. The other thing that's just kind of natural about this, if you look at Amazon right now would be just barely over the line, and moving from non-core to core. And I think, that type of thing, without getting trapped up in the specifics here, it makes sense. Companies, as they mature and enough information becomes available, I think a natural move from non-core to core makes sense.
Oh, I absolutely agree with that, Mark. And the only other thing that I have thought about since we first brought this back and forth between each other was that maybe you look a little bit harder at your smaller companies before you're willing to make them core after 8 years of experience. That maybe if it's a small company, maybe you hold out for 2 recessions. Now, almost every company has 1 recession now, but maybe you hold out for 2 recessions on your smallest. Your ones under $1.5 billion in revenue or sales that are really at the high end of where we know they can be maintained. But those are all ways we can polish this thing up. I think as a general rule of thumb, I think this will work.
Okay, so we thought we'd kick it out there and kind of open the floor for comments. The other thing that occurs to me as I hear you say that, Ken, is when I think about how Hugh McManus looks at companies and when he puts his price range together, if he's dealing with a more speculative company with limited history, he often will, his look back period for recent severe market low will actually go back farther. The same type of concept of almost requiring more from that smaller, more speculative company.
Yeah, well, I guess what I'm saying to myself is that I'd like to make sure that the management which is going to run the company for a while, is the management that we have, that we're measuring. With this latest recession just past us, for a brand new, small company, I know that the management shakes up a lot of times around year 2, year 3, year 4 in some of these small companies. So I'd like to keep that kind of at least in the back of my mind. Ann Manning is telling us that this makes sense to her, so there's a good vote for it. Cynthia is saying this makes sense to her as well, and thanks for the insight on what focusing on quality and stability really means. That's the idea we've been trying to put forth on core since we started talking about it, isn't it?
Yep, and I guess one other point we ought to make, since some people are probably new to this and wondering, are these guys just bantering back and forth over something which doesn't matter? And I guess I would make the point that our treatment in terms of buying and selling the companies can be strongly influenced by whether it's a core holding or a non-core holding. And what I mean by that, again, just to give a quick nutshell response, if we think a company is a core holding, we pretty much will hold it until its return forecast approaches money market rates, which these days is basically zero. In the case of a non-core holding, we might be willing to sell it if that projected annual return approaches the median projected return for the market, or the market average, which right now is about 5%. So again, there are differences in how we regard and how we handle them in the management of a portfolio. That's why we're not just dancing on the head of a pin here. And
then of course the size allocations, that you're still looking for 75 to 80% of your portfolio to be core, and for the other 20 to 25% perhaps to be non-core, with the proviso that that's completely up to the creator of the portfolio as well. That we've seen plenty of successful investors that are 95% core, and we've seen other people become successful at ratios that are a little bit more aggressive than that 75% core and 25% non-core. So there's lots of things that when you're finally done, you have to consider about this core non-core. I think it all boils down to the fact we know that a non-core portfolio, 100%, probably presents a lot more sleepless nights than we'd like to admit.
Mm-hmm. Absolutely. And Ken, I'm getting a private message that if Mark and Ken are dancing on the head of a pin, it's got to be one heck of a big pin.
Thanks, guys.
we could block that individual.
Okay.
We're going to have to learn how to block people. Oh, good.
I think we're all set then. I'm looking at the old clock on the table here, Mark, and I'm coming up about 2 minutes to 3 o'clock, and we have covered most of the questions in the questions box.
Fantastic.
I don't see any hands in the air, so.
Well, let's just do our quick reminder that we do archive these sessions, and we archive the roundtables and the special educational events like the COVID Cancellation Conference 3 that Ken and I were just talking about. We will deliver that and archive that at YouTube. You just search on Manifest Investing and you'll find your way to this. You can subscribe and you'll be notified anytime that we add new content to the site if you're unable to make one of these afternoon sessions, for example. And I guess we'll just leave with a reminder that we'll be back in a week, and next week we'll be hopefully entertained by our resident Irishman. And if not, we'll just go ahead, Ken.
We hope folks to get material out on that COVID cancellation conference the beginning of April. But if you want to save the dates, they're going to be in the late afternoon, May 12th, 13th, and 14th. That's a Wednesday, Thursday, Friday. We'll have lots of information coming out first week or so in April.
Good stuff. So with that, it's time to go shopping for some corned beef, and some cabbage for the annual feast. And everybody out there, please enjoy. See you in about a week.
Good night, everybody.